Good morning, and welcome to our seventh In the Room webinar, In the Room webinar series. So great to have you all, and as always, we really do appreciate your time. We know it's precious. There's a lot going on. There are a lot of these types of webinars, so we really do appreciate it. My name is Steve Backhouse, and I'm your host. And today I'll be chatting to Jacobus Lacock from Fairtree. Welcome, Jacobus. How's it? Yeah. Before we get going, just a quick announcement, and then I'll get into the house rules. So a lot of you, I'm sure, will understand that there's a lot of work that goes into these webinars behind the scenes. And then we've got one person who does that for us, and she literally does the invites, the organizing, briefs the presenters, and all of that. So, and it's her birthday today. So a big happy birthday to Simone, who sets these things up for us. We really do appreciate what you do in terms of getting these things up and running, and you're one of the main reasons why these webinars are such a success. So happy birthday. Cool. So then just moving quickly on to some of the house rules that I often get reminded about because I sometimes don't cover them all. So just checking. So first of all, we do record these sessions. And the recording is sent out in the thank you mailer. So that's the one. And then it's a key thing, obviously, is we try and make these webinars as interactive as possible. They're not a fund manager presentation, but they are interactive. I ask a whole bunch of questions to Jacobus, but also please, we really would love to just hear from the audience. So please post questions through the Q&A, and then we will moderate those, and then ask them back to Jacobus. Again, I think what I'm going to try and do is I'm probably going to chat to Jacobus for about 20-25 minutes, and then we'll have almost a little pause, and then we'll get into the questions, and we'll take it from there. The webinar is 1 hour, so we end at 10:30. I'll make sure we don't go over that time. Again, we know your time is very precious. And then lastly, on the house rules is CPD points. We know the all-important CPD points. So just a reminder of the process. So for this webinar, unfortunately, only receiving half a CPD point. I'm not sure really why, but and then what we do is you receive in the thank you mailer. Importantly, you need to attend the majority of the webinar, so it's like 90-95% of the webinar to get your half a CPD point. If you're unable to attend the entire webinar, you're able to watch the recording, and then there's actually an assessment that you can do to get your CPD point. So I think that's it from my side in terms of the house rules. So Jacobus, how's it? And welcome. Great to have you. It's nice to see that you're in the office and not at home. It just shows that we are returning to a little bit more normality. But before we get going, maybe it's worthwhile just for you to tell us a little bit about yourself, your kind of industry experience, interests, etc.
Yeah, Steve, thanks. And thank you for the introduction and for hosting us today. And good morning to all the listeners. Yes, so I'm sitting in Stellenbosch where I studied. I did economics here. And then after my studies, I went to the UK, to London. I worked there for before I joined Fairtree. I worked for Goldman Sachs Asset Management on their fixed income side. So on the emerging markets and global fixed income side, we monitored and built portfolios for clients. And then in 2011, I came back to South Africa. I think these mountains behind me led me back to some extent, and joined Fairtree, and I'm currently the macro strategist in the business, also co-managing the balance fund with Steve Brown and our alternative fixed income fund with Ian Millard. So I spend my time analyzing the global macro environment, making asset allocation decisions, and managing fixed income. So that's kind of on a daily basis, what I'm doing, my role in the business, and some of my background.
Yesterday when we had a catch up, you were wearing a Cape Epic shirt, so you're also a bit of a cyclist.
Yeah, look, I think the the photo at the front of this invitation is a little bit misleading. I mean, I'm not a big guy, but I certainly have lost a lot of kgs, since over the last few years, being drawn into cycling. So yes, one of the things I enjoy with my friends and family.
It's quite an achievement to do that thing. Okay, so also just for the listeners, I mean, so Fairtree is not one of your your big brand names, big asset managers. So maybe it's worthwhile just touching a little bit about Fairtree, the type of business it is, the size, how many investment professionals there are, and the like.
Yeah, so Fairtree incepted in 2003. And since then, at the moment, we're running about 80 billion of assets under management, about 70 investment professionals. So we're not quite a small shop, anymore. But I think there are certain aspects of how we operate that certainly you can say boutique-like. But we're managing assets across long only and hedge fund strategies, alternative strategies. We actually started initially managing alternative strategies from 2003 until today. But the long only side really started to develop, in the last decade. So we've been able to build a very strong track record across different teams in the business on the long only side. So how we are set up is that we've got specialist teams that focuses on different asset classes, and that's also what you get through our balance fund, specialist investment teams that perform the security selection of those asset classes. And so everyone is responsible for their own product and their own performance. So everyone lives by their own product essentially, and therefore is incentivized to really grow and strive to excellence in that particular bucket, and that's worked well for us. In the way that the business is managed. I think it's important to note that the business is therefore run by portfolio managers. So the end result is that we can provide the best outcomes for our clients in terms of performance, in terms of risk management, and we are structured in that way to be able to perform that.
I mean, so you mentioned the word boutique there, and today was one of the themes of the webinar to get the insider boutique asset manager. So you would classify yourself as a boutique?
I think the teams kind of are structured as boutiques. It's difficult to say because we've really been able to fortunately grow. Yeah. But I think the genesis and the culture and the way we operate, in terms of the flexibility of the different teams, everyone being responsible for their specific product, and also we don't have a overall investment view within the business. Every team forms their own view given the inputs that we receive from analysts, from guys like myself, and therefore everyone's responsible for their specific area. So I think that what that does is it increases the breadth of the investment decisions. It increases potentially the quality of the investment decisions because we get different views. We encourage to have different views, and therefore it kind of increases the quality of your thinking to some extent. But everyone's kind of flexible, and we are, with the genesis being on the hedge fund and alternative side, we are very active. We therefore need to be very nimble. So if you think about our culture, it's really to add value, not to be necessarily right. So if I have a view and the dynamics around me changes, I change my view, and we change the portfolio on the back of that. There's no incentivization to keep you married to your view or married to your investment decision.
So you touched on almost like the way you structured and kind of that obviously gives you some opportunity. But I mean, if I just try to think of, you just said, so I think you've said you got 17 investment professionals.
70.
70, okay, good. So yes, 70 staff, yeah, okay. I was hoping it was 17, not 17. No, but again, so obviously, some of the bigger players in the market who've got much larger assets. What kind of if you structure from a boutique perspective, what challenges would you face versus maybe some of your bigger competitors So kind of the difficulties, because you kind of maybe a little bit smaller. So you talk about that the fact that the business is actually run by investment professionals, which is great, but you're also running a business, so you might be wearing two hats. And then also, how do you maybe overcome those challenges?
Yeah, so I think because it's fairly decentralized in terms of in the different teams managing themselves essentially, nobody's overbred by having to focus on the bigger issues of the business. The guys that's really able to drive the business. Our CEO, Bradley Anthony. He's responsible for kind of the structural issues within the business and driving the business forward from a strategic point of view. So we have a very strong infrastructure in terms of our marketing, distribution teams, and those are all set up, and those make part of the 70 people that I've alluded to. So it leaves our investment professionals to really focus on the portfolios. In terms of, therefore, I think our biggest challenge relative to some of the bigger players is that some of the successful competitors have been able to build a strong brand and trust over time, and that's certainly something that it does take time to build, and it's something that we are aspiring to do. I think given our track record over the last decade, I think it's something that we've done so far quite successfully. So that's certainly something that I think we would want to build further towards. In terms of the opportunities that we have, is that just by the way of managing a portfolio, to use an example, if you want to make a meaningful investment into a high conviction investment vehicle, often a large manager finds it difficult to actually enter the trade because of liquidity constraints. And also, if they do take a stake in that business, it's often a very small part of their portfolio due to maybe some liquidity issues. So, for example, last year, Implats was one of the biggest performers in the index. By the end of 2018, we could take a sizable position in that business. Whereas a business that manages, say, 100 billion in assets, for them to have taken the same size, that they would have had to buy essentially 10% of that business. So that could be difficult to implement. So I think that fits our style in that we are flexible, we are nimble, we're able to enter and exit trades. We're focused on the most liquid parts of the business. Another example is to take Sasol earlier this year. When we saw trouble, we could get out of the position within a matter of 2 days. So I think that really fits our style, relative maybe to some of the larger competitors.
Yeah, I was going to say, it's one thing is getting in, but it's also the timing of getting out and being able to get out is critical. And Sasol's a great example, and I do know that some of the bigger guys had challenges of getting out when they want to because of their size and the size of stake that they own in some of the stocks. So I mean, you've touched on kind of Sasol beginning part of this year. It's been an interesting what we're now into. We're halfway through August. It's been an interesting year. It's been a volatile year. I mean, how's 2020 treated you and the team up to this point?
Well, Steve, that's a good question, because we've been managing our balance fund now for the last 3 years, although the underlying strategies that makes up the balance fund has been around for much longer, so long track records. But in terms of the asset allocation and how we structure the fund, how we think about the process, we were tested a little bit in the back end of 2018. But last year, I think, was the first time that we were really tested, in terms of our investment process, our philosophy. And, we just stuck with our investment process. We were committed to our process and what we believe. And that actually came out well for us, in the end. We set ourselves certain indicators that we would look at to identify a crash scenario. We from the start felt like this was a different type of shock, in that it was an external shock. It was also a shock where we went into this with the global economy actually in a fairly good position.
You're talking about the COVID kind of market,
yes,
market shock.
Yes.
Yeah.
before we entered the COVID shock, the global recovery, the global economy was actually starting to recover to some extent. So we stuck with our process throughout the time, and we've been able to generate, good returns. I think year to date we are up about 12% over the last 12 months, about 20%. So over a 3-year period, I think second in the peer group. So a good result given all the volatility and that we saw this year. So I think in terms of what we've done and what has worked for us is, we came in this year kind of fairly defensive to some extent. We still like growth assets, and we still wanted to participate in the market, but we started to buy gold more in the portfolio towards the back of last year. And then I think when we first start to see the COVID hitting China, but still just predominantly within China, we used our security selection to sell luxury and travel. Some of our diversified miners we've sold. We bought more gold into the portfolio. But when we saw the crisis actually spread into other markets like Italy and Iran, and community spread within California, I think that is when things have changed for us. We saw this is a health crisis that could actually run into a financial crisis, and we started to cut our growth assets in the portfolio. So our equity positions, we started to cut those. And then, a lot of us in the business has been through, or myself and Steve, we've been through previous crises before. I mean, I was actually joining Goldman Sachs just before the GFC crisis in 2007, 2008. So we've been in those environments. We know what's required, and I think for us it was key to see very strong policy response from authorities, fiscal and monetary. So we waited until we saw that. I think we were a little bit early. In the beginning of March, the Fed cut rates by 50 basis points. We thought that was going to support the markets. We increased risk. That was probably a little bit early. We waited then a little bit, raised some cash, and then at the back end of March, when the Fed when the Treasury came out, US Treasury with that $2 trillion fiscal package, that is when we put all the risk back into the book, and from there it obviously has not been a straight line, but it's been we've seen a very solid recovery after that.
Yeah. So I mean, on that, you mentioned gold. We often get a lot of questions about gold, and gold's kind of in the news a lot. I mean, they had a record high quite recently, I think it was. What's your outlook on gold, out of curiosity?
Yeah, so we like gold, and we like it for different reasons. And we like the gold companies as well as the physical, So in the short term, and the long-term drivers. So in the short term, we think that with some election risk coming in, some geopolitics that's in the fray, gold could be supported. We think the policy response to the crisis has been very aggressive, in terms of the speed, in terms of the size, how it's been structured, the amount of liquidity thrown into the market. And when you look at that liquidity, back in 2008, a lot of that liquidity actually just went into delever the economic cycle. This time around, we don't have that leverage problem. We actually went into the crisis, as I said earlier, fairly strong. So what you see is that liquidity actually makes its way into the real economy. Some of that's going straight into savings, so it becomes kind of pent up demand maybe in the future. But it's actually, to some extent, like money supplies has ramped up, across the developed world. And so we think that actually, provides us potentially with a period where we will see reflation. Not necessarily hyperinflation, but a period in which we'll see higher inflation. And very important, and this is key, is that the Fed itself wants inflation to rise above its 2% target. So for the last 30 years, the Fed wanted inflation at around or just slightly below 2%. And we will see maybe over the next few months, the Fed going through the process in which they're reviewing their whole reaction function and saying that they they want to see that inflation target being symmetrical, which means that they will allow US inflation to go above 2%, for an extended period, in the same way that inflation was below 2% for an extended period of the GFC. And why that is important is because that drives down your real rate, and real rates is key to gold. So gold doesn't earn any yield, but if treasuries or government bonds are earning a negative 1%, then gold is so much more attractive than government bonds, developed market bonds. So for us, we think that's a key change for how we should think about gold, in terms of the real rate, in terms of the geopolitics that's potentially still play out for the next few years, because the China-US relationship is a long-term issue that we will face. Biden will also be very hard on China. And then we haven't even talked about the scope that the US dollar could weaken, and which is also one of our views. And in that environment, it will potentially help gold as well. So it's not going to be a straight line. If the world recovers very quickly in the next 6 months, gold might take a bit of a seat back, but I think the longer term drivers remain very supportive for gold. And the gold stocks hasn't really priced in the gold spot price where it is at the moment. So therefore we like the combination of both.
So I asked about gold, but then also you touched on inflation, which for us is, I often get a lot of questions on inflation. And we know, inflation is such a key part of impacting the real return of a client's investment. So now, if the US inflation kind of goes above that 2% mark, what impact that will they have on our inflation in our market? Because again, we've had rates. Inflation is actually quite low. Rates have come down, and do you see that kind of then also kind of turning and heading upwards?
Yeah, so that's a good question, and that's something that we think about quite a lot in terms of how the world responded to this crisis. So if you just look at the US for 1 second and how they've responded, and then we look at the emerging markets. Essentially what the US has done is, after the GFC, you've seen income levels actually dropped. In this crisis, you actually see income levels rising. Why? Because the key focus was to support incomes, was to support jobs, unemployment insurance, putting checks into the post box for people, $1,200 per family, and there's more to come. So the whole focus wasn't trying to. So what you actually end up is what you are stimulating demand, but your supply side remains under pressure. So when there's more cash or income chasing or demand chasing less goods, you actually you create to some extent inflation. So that's a very simple kind of just the response to this crisis. In turn, it's completely around when you look at emerging markets. Emerging markets were not in a position to provide that same stimulus or that same support to their market. So where in the developed world, it's potentially an inflationary shock or demand shock. It's a bit more of a supply shock in the EM space, which means maybe more deflationary. So our inflation, I think, in South Africa wouldn't stem from the way we responded to this pandemic. I think it's more relation to supply side issues from electricity prices going higher, from maybe labor costs remaining quite high, food prices rising. My wife comes home every second day and says, food prices are rising. So we can start to see how these things, not demand side driven, supply side driven, puts pressure on inflation. But we remain fairly benign at this stage about the inflation outlook for SA. Maybe we go back to at 4.5%, 5%, but I don't think we'll see us going above that 6% top end of the target range anytime soon.
You touched on electricity, and as you know, last week we had some load shedding, and just before this webinar started, my street WhatsApp group was going crazy because everyone's power was going out, but somehow mine has stayed on. luckily, otherwise I might not be here at the moment. So we actually got a first question coming through. It's from Lee. So basically he's asking, so Jacobus, who manages the fixed income portion of the balance fund? Is it yourself or is it Paul Crawford's team? If it's Paul Crawford's team, is the mandate the same as the Fairtree flexible income mandate, credit heavy?
Yes. So it's Paul's team that manages the fixed income portion. But if you think about Paul's structure and his fund, it's credit. And maybe I just have to answer the second question. It's not exactly the same as his flexible income fund. It's the Orbi Plus. He's got another fund that he runs, the Orbi Plus fund, which is essentially taking duration, where you mirror the Orbi duration in the fund, and then you add on credit to that. So if you split it up between where the actual risk comes from, about 30% of the risk comes from credit, and the other 70% comes from just mirroring the Orbi index. So you get your Orbi return, your duration return, with a little bit of enhancement from the credit side. So it's therefore slightly different to the income, flexible income. What we did then do myself is, if we have a view on duration, we can tilt the duration positioning in the book to be maybe slightly overweight duration or slightly underweight duration. So we just on the edge manage the duration as well. So for instance, right now, the SARB has been cutting rates for the last few months. So we were slightly overweight duration, so with the view that yields will come down at the front end of the yield curve. So between that up to 3-5 year space. But now that we believe we are getting to the end of the cutting cycle, and there's opportunity further out on the yield curve, so between the 20-year and the 30-year, we're actually increasing duration slightly at the back end of the yield curve. So that's how we employ those duration decisions to just enhance it from a duration side as well.
Cool. So another question, someone's picked up that you got quite a decent property chunk in the balance portfolio, which I think is unusual for kind of the balance funds at the moment. Most people are kind of got a negative outlook on property. Can you talk us through kind of I think it's an 8% weighting when I had a look in the property fund, in property in your balance fund?
Yeah, so I think that 8% maybe referred to the June position. So
yes.
Where we stand today, we see there's severe headwinds for the property sector. Okay, so we actually, our current position is 6%, and that 6% is made up out of about 2.5% offshore, and about 3.5% local, whereas our neutral position is 5%. So we are slightly underweight at the moment. So where that 8% came from was at the back end of May, some of the asset classes has read quite a bit. Property was still lagging. We saw an opportunistic or an opportunity to just take it back to neutral, and so we've increased our position back to neutral, back to 5%, and then beginning of July, end of June, we've sold out of that again to bring it back to below neutral, so underweight. So it was a bit of an opportunistic opportunity that we've used. It benefited us in that we've had that re-rating, of the property sector at the back end of May into June, about 10-15%. So there are some names within that sector which we like. That's more defensive, so don't own any office, or where it's retail, it's more retail that's geared towards the lower LSM groups in maybe rural areas, which is more defensive. But the sector as a whole, still faces a lot of headwinds in terms of supply, in terms of balance sheets that needs to be repaired, and so we'll be waiting for for that to happen before we, I guess, take a more structurally long-term overweight position.
Yeah, I mean, I've spoken a lot about property in the room series, and again, I mean, I mentioned it, and I went to the Rosebank Mall, I think it was end of last week, and it's scary how again in the last month, how many stores have actually closed in the Rosebank Mall. And you walk through the corridor, and literally the whole of the left-hand side is boarded up. Yeah, and you can only think, wow, the pain that some of these guys must be feeling. And we've also spoken a lot about you mentioned the office space and the fact that for example, so I'm still at home. People are now going, hang on, we don't need big offices, etc. So yeah, the headwinds are definitely there for some of the bigger guys, I suppose.
Yeah, but maybe just on that, so like for instance in the global space, we logistics and industrial spaces, they become obviously quite popular at this stage, and there's some value there. So Rob Hart, that manages our global property fund, that's where he sees value and where we are positioned. That's where we've got still a neutral position on the global property side. So there are some losers and there are some winners, and it's our job to find those and find the opportunities.
Yeah, we also had a chat with Tom Walker from Schroders a few months ago, and he spoke about data centers. He says data centers, massive opportunity in data centers. So exactly. So there's absolutely. So just moving on then. So just so kind of trying to also bring it back, the conversation back to kind of the questions and the conversations that our advisors would need to have and do have with their clients is kind of what do you think the biggest risk investors are facing in the next 12 to 18 months? Again, things that advisors need to be kind of educating their clients on. Again, so also as we know, there's a lot of noise in the press. Clients are reading headlines, and actually we do know the basics of terms of kind of stick to your guns, stick to your goals, and staying in the market. But you still need to be able to talk to the clients about kind of what the risks are, and then conversely, what are the potentially the opportunities off the back of that?
Yeah, so I think in terms of the risks, I can think about maybe 4 or 5 risks that's out there, which I think is important enough to at least monitor on a daily, weekly basis. And the first one obviously is maybe call it geopolitics. And let's include maybe the US election in that. So politics and geopolitics, with the US election being most front and center right now. I don't think it's is necessarily a big risk in that it will take the equity markets back down to previous lows. But I think there's risks that's different to previous elections in that pre-election risk, election risk, and post-election risk. So pre-election, it is all about how are we going to get at the voting polls, and what are the policies going to be up until then. So if you look at Trump, for instance, his approval rating at the moment is 43. He needs to get back to 46, 47 to have a chance. The bookies is giving Biden a 20-point advantage there.
The question on that, sorry, question again. It's so, and I don't want to lose your train of thought.
Yeah.
But I remember when Trump won, it was a complete surprise.
Yeah.
So I mean, are these polls accurate?
Good question, and that's why we need to look at as much data as we can get. So we look at this, what the swing states saying. We look at what as I said, the polls, the bookies. Often the bookies are more right than the polls. What they're saying, but also if you analyze the themes on which the election has been run on, and I think this election has been going to be run on the response to COVID, the economy, the social instability that we saw more recently, and China, and I think in all of those or most of those, apart from the economy, Biden potentially has got a better chance. So that's why we favor Biden to win. We give Trump maybe 35 to 45% at the moment. It's not too late yet. He can still come back if the economy improves. But the Democrats are trying their best to ensure that this fiscal package has to come onto the table and to provide people with again that income support. They're trying their best to keep that off the table so that the economy just continues to struggle along before we get to the elections. But to get back to what about the risks and so on.
Yeah.
I'm digressing there. So I think the US elections is a risk in that even if we get to the elections, will there be a contested result? And then after the elections, what will Biden's policies be? We know he's going to potentially hike taxes and increase the minimum wage, but he's also going to potentially provide a more certain backdrop for trade with China. So there are some risks in that which we have to monitor. The second big risk, I think, as what I mentioned earlier, is potentially inflation. It's not a near-term risk, but maybe a longer-term risk, is that if the market starts to question the Fed's ability to really keep inflation low, that could become a risk for the market. Because what happens is that the 10-year is trading at about 60 basis points at the moment, very low. Although you've seen economic activity rebounding very sharply, so there's a big gap and potential for global bond yields to increase. We don't think it will, because the Fed has got credibility to keep rates where it is. But if that does happen, that will be a big risk for your long duration assets, your growth assets. Think about your FANGs, your tech stocks, which is really rallied on the back of lower discount rates. So that could be a key risk. And the geopolitics, to come back to geopolitics, the relationship with US and Iran, US and China around the South China Sea. You saw just earlier this week that Taiwan bought some F-16 fighter jet planes from the US. That's something that we have to watch, because if the US can keep trade around the South China Sea to some extent, be able to monitor that, they actually have a handle on about 6-7 trillion of global trade that passes through that area. And China knows that. They want to keep those waters to themselves to be able to monitor and regulate that. So that, I think, is a very important geopolitical risk for the long term. And then, so we talked about geopolitics, inflation. I think there's also market risk. If you think about concentration in the market, bond yields being very low, gold being high. So there are some valuation risks in the market, which I think short term you can see a bit of a retraction. So that's why on global we are slightly more pessimistic or less optimistic on global equities because of that. But I think those are the key risks. And I think where the opportunity sits is not to go back to gold, but I think gold is a potential key one. But also with this amount of liquidity thrown at the market, with real rates being so low, and policy likely to remain accommodative, both from a monetary policy side as well as the fiscal policy side, the opportunity and the pain trade is likely that we could see this bull market extending for a long time into bull territory. It's possible. And so that could be a pain trade for guys that's waiting for the pullback. And then we can see that there's no other alternative to actually buy or to invest in actually risky assets, because global government bonds, I think 83% of them is yielding less than 0.5%. So where are you going to put your savings? I see some guys are saying, forget about the 60-40, balanced portfolio. You should have a lot bigger portion within equity, because where are you going to get your growth from? And that then stems back to that if there's the search for yield, then at some point emerging markets will have to start to benefit. And we're not there yet. I think there's still too much uncertainty at this moment. But I think we can go back to just after the GFC, before the taper tantrum in 2013, was a very good environment for emerging market assets, local fixed income, as well as on the equity side. We could see that again, maybe developing over the next 2 to 3 years, and that could be an opportunity.
I suppose you're also going to be able to get through this time of uncertainty of COVID and all of that at the moment before you've seen that come through. A couple of questions have come through, which I'd like to get to. So the first one is from Anonymous. I do like when people put their names, but I do understand. Is SA going into an extended recession or depression? what is your view on investing new money now, offshore or local or both?
Yeah, that's a very deep question, and if there's extra CPD points that we can hand out, maybe that you should get one. Unfortunately, we don't know who he is, but I think that's a very good question. That the challenges that faces us at the moment in SA is to an extent, it's a fiscal challenge, which is more structural in nature, which will take years for us to actually get our debt to GDP back to levels where we feel, the government can really support areas that needed support the most. And then that links into growth to an extent, in that our economy is just uncompetitive in terms of where it is at the moment, relative to our trading partners and relative to history. So we desperately need reforms to take place. And those reforms are political reforms and economic reforms. And if I look at, and this is the way I analyze policy, is, I make a distinction between what government is doing and what the ANC or the ruling party is producing. And maybe similar to what we've had in the Mbeki days, we see some daylight between those two. In that the government takes a much more pragmatic approach. If I think about what Treasury stands for, but what they want to implement, than what the ANC's own policy documents is putting forward. I also look at and see that to some extent the ANC's own policy documents have become a little bit more moderate than what they were maybe 2 to 3 years ago. So if I think about the long-term trend and the path, I do see an increased willingness to reform. I still see some people have to come around the table and being convinced more about what the right path should look like. But I see at least there's a bit more of a willingness within the ANC, especially within government driving that. And on the political side, we can broaden that maybe into the institutional side. There's also a trend to reform our institutions. We can think back about Eskom 2 years ago and management within Eskom 2 years ago. Same with the NPA, the Hawks. All those institutions has been turned around by better leadership now than has been 2 years ago. And although it's a long path and there's still a lot of structural issues within some of those institutions that needs to be addressed, I think that to me speaks about a potential new trend that's starting. So I do think that the willingness is there to put us on a better growth momentum going forward. It's going to take a long time. It's not just going to be the government, it's going to be the private sector as well. And so if you ask me, should you put your money in SA or take it elsewhere, I would say, like any portfolio manager, you should have a diverse portfolio. So you typically manage or match your liabilities with your assets. So if you have liabilities offshore, or if you plan to have future liabilities offshore, maybe you want to take your kids to study offshore, you should, naturally have some offshore assets in your portfolio. But I think in terms of a opportunity set, there is a big opportunity set within South Africa. What we are missing is that SA equity market does not reflect the SA economy. And therefore, we could sit here with the equity market almost back at pre-COVID levels, but we've went through a credit downgrade. We've went through, a recession that started before COVID. And so I think if you look at our equity market and you look at the breadth of the equity market, resources, and within resources, it's not just the diversified miners that benefits from China and from global growth. It's gold that's driven by completely different drivers, some of them which we've discussed just now. It's also platinum or the PGM basket, which been driven by completely different drivers. It's energy, it's paper. Those are all subsectors within resources, and completely different drivers affect those. And then you've got your global consumer stocks. Then you've got your defensive stocks, global defensive stocks in SA. Again, different drivers, global drivers. So for you to get exposure to global themes, you could actually access those through sectors and stocks within SA.
Yeah, no, absolutely. Beauties of working at home. Someone's hooting at my gate, but I suppose they're gonna have to wait. Cool. There's another questions come through is from Sabrant. Current valuations of DM, so it's developed markets, and what are the current valuations of DM markets, and is there a disconnect between the economy and the market? Gee, I mean, from a local perspective, I think you just touched on that. From a developed market point of view.
Yeah, if you think about the valuations at the moment globally, then you have to, and we often compare that with what we saw in the most recent history, maybe before COVID, and the key thing there is that we actually saw the discount rate drop from about 2.5% to 0.5% globally, and that by itself means that you should your valuation should rise. The other thing is that has changed for us over the last year is, remember back in 2019, Fed started to cut rates again, but it was, the market was saying, why are you cutting rates? You should keep some bullets for when the crisis really hits. The economy is actually growing strong enough. You should be hiking rates potentially again in 12 months' time. So there was a lot of uncertainty about what that discount rate is most likely going to be over the next 3 years. Today, the Fed has told us in their own dot plot, which they produce every second meeting, they won't be hiking rates in the next 3 years. They will keep it at these levels for the next 3 years. So the amount of certainty that you have, not only from a lower discount rate, but the certainty that you have that discount rate is going to be low for a pretty long time, also changes the dynamic in terms of the valuations that you should be willing to pay for getting into some of those growth FANG stocks that has really driven the market higher. So the question is, are we going to see a collapse in some of those? I think there's less margin of safety in some of those stocks. So we are cautious, that those sectors and those markets. But what it means is that those sectors that have lagged, your cyclicals, your value stocks, they could actually, there's some decent upside scope for them to move higher and almost like recouple with those sectors. And that is, I think, the areas which we need to watch to see the catalyst. I think the weaker dollar is important for that, where we could see some value maybe in the future. So I don't think there's a disconnect between the economy and the markets. I think the fundamentals are driving them as they are, at the moment, but it's not going to be in a straight line.
No, it never is, unfortunately. Another question then is, so we've touched on gold, but Andrea asks I think we've touched on your view on gold, but you also have gold is overpriced, and is there still room for growth? I think you've answered that in terms that you absolutely think there's room for growth. And you mentioned there's potentially in terms of the actual kind of gold producers, there's a lag effect because the kind of the spot price hasn't come through to them just yet. Am I summarizing it correctly?
Exactly. I mean, those mines are producing big cash flows at the moment, very cash flow positive. And so we don't see them as really pricing in the extent of the spot price. Even if you look at gold, how it reacted last week, last week we had a bit of a fallback in the gold price. And that reaction since then kind of showed you that some people, gold is only a $6 trillion asset, global asset. It's not massive, right? So every time you see a bit of a sell-off, I think there will be new buys that will come in. Positioning has to be cleaned every few months, So just on a real yield basis, maybe gold is probably a little bit high at the moment. But if you factor in geopolitics and the weaker US dollar, then I think there's still upside scope.
Some legs still. Another question which we get on a regular basis is what's your view on the rand dollar? I mean, I know it's a very difficult currency kind of exchange to call, but yeah,
Yeah, so if you go back to kind of the themes that I'm trying to convey here, if we are going to see a bit of a global recovery, the US dollar is a counter-cyclical currency. The US investor likes to take their cash outside, or corporates to take it outside when the globe starts to recover, and therefore the US dollar weakens from a more cyclical perspective. And then the US is sitting with a massive twin deficit, in the current account deficit as well as the budget deficit, much higher than that of Europe. If you compare US with Europe, how they went through the crisis, I think Europe hands down won, in terms of if you just compare Merkel's response to the crisis versus Trump's, and how those economies fared post that. So, and then we've also had more recently a European package, a Europe-wide package that was announced of about 750 billion euros, which I think is key in that it sets, it kind of showcases that the European experiment to keep the countries together is most likely going to be successful, at least in the medium term. I mentioned that to say that the drivers for the US dollar has moved from being bullish to bearish, in that I think that the US dollar will face some significant downside potentially over the next few years. And that is good for emerging markets, and that is good for the South African rand. We often look at the rand and we marry what's happening with the rand to what's happening in our politics in the country. The fact is that the rand, if you look at this year's rand performance, the performance from the beginning of this year up until the crisis, and then from the bottom of the crisis until now, SA has performed very well, or very similar to the rest of the emerging markets. In fact, post the crisis, we've actually outperformed our typical competitors. So I think the conditions are there for the rand over the next 6 to 12 months to appreciate. I think we go back to maybe a low 16 handle. But we first have to get through some noises about the US elections, and first need to see COVID drops off in EM, and see some real growth coming through on the emerging market space.
Okay. Question, so we got all that money, what $4.3 billion from the IMF, where it was. So now obviously we have to pay that back. Now, what impact is that going to have on us and our markets? Obviously, a nice capital injection early on, but then kind of the debt repayments and we know that, for example, the socialists don't like it at all because they feel we kind of incumbent now to the IMF in terms of our policies and things like that. So, what impact? Is that first of all, so two things. So, from a policy perspective that you touched on earlier, is that a positive for policy because it forces reform? That's the first question. The second question is is it like, what burden does that bring with it?
Yeah, so I think the IMF package doesn't force reform in the sense that the IMF has given us any conditionalities and we have to adhere to those conditionalities. I think it's more a matter of, we have written a letter of intent to them in saying that we want to keep to the Treasury's budget plan, the emergency budget that they've announced. We want to keep inflation at about 4.5%. That came from the SARB, and so I think there's a buy-in from government to do the right things, and be seen by the IMF as doing the right things, because maybe in 2 years' time we'll need a bigger plan.
Need more.
Yeah. So we want to, but I think it's important to there's no conditionality on this this loan. It comes at 1%, so much cheaper than what you would have had if you had to fund yourself in the bond market at 8-9% at the moment. So I think it's in that extent it's good. It's a viable plan. It's a good plan. It's a very positive sign that the ruling party and the government actually, conditionality or not, accepted the IMF plan. That's something that maybe 3 years ago would be an absolute red line. And today we see that so it's another sign that I think, the penny has dropped, that we have to make the right decisions to get out of this.
Okay, cool. I'm aware of time, so we've got 5 minutes left. I'm going to try and get 2 more questions in, and then we're gonna close. So the first question from Lee: given the levels of both local and global uncertainty, is there a role for hedge funds in a client's portfolio? That's a very good question.
Yeah, and I like that question because, as I said earlier, we do manage alternative assets and hedge funds, and I think we see opportunities presenting itself through this volatility. Alternative managers, they like volatility, they like dispersion across different sectors and names, and so I think in this environment, yes, definitely. And if you look at performance the last maybe year or so in the hedge fund space, you will also see that that they've started to perform better relative to the market, at least, than maybe 3-4 years ago when they took a lot of flack. So I do think that's a space where you should have some of your assets potentially in alternative, invest in alternative assets. Yes.
Cool. And then last question, and I'll go up. I've been saving this one. From anonymous: what keeps you awake at night?
So I think what keeps me awake are maybe some of those risks that I mentioned earlier, because, although I may present you with, with a scenario which is more maybe on the optimistic side in terms of where the world's growing, you have to retest those theses or hypotheses every day, and look at the things that will derail that. So, I am worried if I look at some of the big move in some of the equity markets, I'm asking myself, what could be the catalyst for this to turn? And is it just a mini cycle, 5-10% drawback, or are we seeing a 20-30-40% drawback in the equity market? That's the key thing. And those risks that I've mentioned earlier, those are the ones that that I look at and try and figure out which of them actually have got the potential to take us there. At this moment, I don't see that risk on the table. So I think we have maybe 12 to 24 months that the market will grind higher. There will be some volatility around the elections, but I say 12 to 24 months because I think that's when maybe inflationary pressures will start to really, ask bigger question marks in terms of how the Fed and could or should respond in the future.
Jacobus, thank you very, very much. We've pretty much come to the end. So just quickly, just a couple of some closing remarks. First of all, again, thank you, Jacobus. Really do appreciate it. We've been very insightful and a very, very cool chat. So thank you. Just a reminder of our CPD process and I was meant to do this halfway. Apologies, we got caught up in the conversation. If you attended majority of the webinar, you do get CPD in your inbox in the thank you mailer. If you didn't, then you need to if you didn't, you need to then complete an assessment when you can get your half a CPD point. Thanks for the kind of the attendees for attending and the audience. We really do appreciate your time. Our next webinar is on the 17th of September. And it's a fun one. It's a little bit different to kind of the normal kind of industry conversation stuff. And it's actually with Wayne Barnes, the World Cup referee. I think he was the referee of the year last year. And Georgina Smith will be chatting to Wayne Barnes and David Kirk. And basically, they're going to chat about kind of South Africa's wins in 95, 2007, and 2019, the most important kind of the World Cup wins, and share stories and how Wayne copes with pressures of international rugby, where every decision is a big decision. So I think that'll be really interesting and a good one. It's later in the afternoon, and the reason is so maybe we can have a drink while we listen to that one. So it'll be good. And then the next In the Room webinar will be on the 29th of September, so a little over a month away. And please look out for that. And what we do is we also got a monthly mailer called the Scoop. And the scoop kind of has a summary of all the up and coming webinars. So please have a look at that. That comes out at the end, I think at the end of every month, and looks forward to the future month. Also, please feel it's quite nice to go and have a look at our website, innate.co.za, and there's a section there called Innate Connect. And that has all our different kind of the webinars, podcasts, and all the kind of really interesting stuff that we put out there. So please have a look at that. And lastly, please feel free to follow us on LinkedIn. And again, that's where you'll get kind of all the updates and all the kind of up and coming events and webinars, etc. I think that's it from our side. Just checking any notes. Mr. Simon's kind of telling me if I forgot anything. I don't think so. So Jacobus, again, thank you. Really do appreciate it. And cool. And thanks everyone for attending. Cheers.
Cheers.